Meantime, to chat a bit about the fiscal scenario and the various announcements made yesterday by the Finance Minister regarding the budget, let's bring on board Sonal Verma, the India Chief Economist of Nomura. Hi, Sonal. Thanks a lot for taking time out to chat with us. First up, we all know that the FM did hike the fiscal target for FY18 to 3.5% versus 3.2% earlier. And for FY19, it stands at 3.2%. Nevertheless, is this on the expected lines, or were you expecting something below than that?
So FY19 actually has been revised higher to 3.3% of GDP vis-a-vis expectations of 3.2. So the slip in FY19 is marginally more than actually what was expected. And also the decision to sort of postpone the medium-term fiscal consolidation. So the government remains committed to fiscal consolidation, but the timeline for achieving the 3% target, for instance, is now being pushed out to FY21. So that is second. And third, the decision to basically link minimum support prices to a cost plus 50%. Obviously, it doesn't mean that MSPs will go up by 50%. The actual increase will be smaller. But the fact that we are getting from a period of much lower MSP increases to a period of slightly higher MSPs would mean better rural incomes, but also some pressures on the food inflation front. So it wasn't, I would say, so much, concerns around market borrowing, etc. It was really the slip on the deficit, the postponement of medium term, and the MSP decision overall, which actually has been a bit of a disappointment, particularly for the bond markets.
Give us a sense as to how you've looked at the overall fiscal consolidation path, which seems to be delayed. But compared to some of the other markets or the other EMs, we seem to be a little bit better off. How are you seeing, what is the overall reaction on that front to the budget?
Well, when you compare India to other emerging markets, we stand on and we rank differently on different parameters. When it comes to growth, the economic reform, in general, the debt levels on the private side, or rather maybe the household side, India definitely stands out. But when it comes to, a relative comparison on the general government fiscal, about 6.5% of GDP, as well as the general government debt to GDP ratios, which is slightly above 65% of GDP. Actually, India ranks a bit lower. So I think there are two things happening. One is with oil prices rising, there are some concerns at the margin for a commodity importer like India in terms of the impact this has on both inflation and fiscal. And second, the budget, with the need for India to really consolidate its fiscal finances, given that, the relative position on the fiscal side is a bit weak. The decision to delay the consolidation, has been a bit of a negative surprise. So I would say, on an aggregate basis, India still stands out on an overall basis in terms of one of the better EM stories, but there are concerns emerging on the fiscal front, partly because of the oil price increase.
Right. Ma'am, if you just see, what has happened to our yields compared to what's happening to yields globally, do you think that there is also a domestic plus a global impact where the yields are going up? So that's why there is this twin problem in yields, or, maybe if you could look at the flows in the last few weeks as far as debt markets are concerned and say that, we are facing a twin problem?
Yeah, absolutely. I mean, as you know, the global environment has sort of completely changed in the last few quarters. So we do have synchronized recovery. Oil prices are going up, partly because demand is much better. And given this backdrop, global monetary policy cycle is clearly moving towards removing some of the accommodation that we've had. So globally, that is the scenario that we are facing right now. And domestically, as we know, there have been concerns on the fiscal front. Inflation numbers have picked up. market expectations on monetary policy have moved from expecting more rate cuts after August to now, some probability being given to rate hikes. And I would say on top of this, there are certain concerns on, on supply front for in terms of the government bond issuance, both center and state put together, because, the biggest buyer here, the public sector banks, there are question marks on whether public sector banks will continue to buy as much as they have in the past for various reasons. So a lot of these factors have actually come together, and that is primarily the reason why we've seen the kind of yield increase we've seen without the Reserve Bank actually doing anything on monetary policy.
Right, but overall, such sort of corrections, such sort of shocks coming in the near term can have huge impact on flows and macroeconomy, or other rates or equity markets.
Surely it will. The fact that the risk-free rate as well as most other money market rates have moved up does indicate that at the margin financial conditions in India have tightened. And the second issue we are facing is with oil prices higher, essentially that is a negative terms of trade for us, which will also weigh on growth. But the issue is that the adverse effects of some of these changing macro conditions are typically felt with a lag. So I don't think this means that growth numbers start falling immediately. If anything, actually what we'll see right now is stronger growth because we are getting out of the the GST disruption, and we also have a comparison to last year of demonetization, where there is actually remonetization going on, and you have strong global demand. So near term, actually growth picture still looks extremely strong. We actually think that the growth numbers in the near term will show a V-shaped recovery, given what the factors that I mentioned. But the point that you make is quite important. The fact that at the margin financial conditions are tighter, oil prices moving up, do mean that we could see some moderation in the growth numbers. But I think a lot of this will show up more in the second half of FY19 rather than in the next 6-9 months immediately.
Okay. And the big talking point really, Sonal, in the last comment from you, the introduction of LTCG, do you view that as a negative? How do you think that, domestic and foreign flows are going to be impacted for India now post this? And what's your overall assessment of the move?
Well, I think going into the budget, while there were fears, I think most participants were expecting, the definition to be tweaked from 1 year to 3 years. So the LTCG clearly has come in as a bit of a negative surprise, and therefore we've seen the adverse reaction that we are seeing. Beyond that, I think ultimately the decision will be based more on how the domestic fundamental picture pans out, and if the India macro story overall and the growth cycle, etc., remains one of the better ones in emerging markets, then this should end up being more of a short-term rather than a medium-term, impact.
Right. Sonal, thanks a lot for chatting with us on your views related to the various announcements made on the budget, and of course on the fiscal concerns and the LTCG tax and everything else that matters. Thanks a lot for taking time out again.